Let's talk about Nate Most. We're now at indexing 2.0. We're not going to spend much time on 3.0.
No, exactly. Well, so Nate Most, also fascinating character. One of the people I sadly didn't get to interview. He passed away a few years ago. Right. But one of the people that passed away, one of the people I most like to talk to, also fantastically nomadic career. That essentially, look, I don't want to be, I hope I don't sound harsh here, but kind of a nobody, like one of those people who's really smart. He did a PhD in acoustical engineering, worked in the sonar during World War II, but bounced between many jobs, not through any fault of his own. He just was really unlucky with lots of random companies where he worked at folding, until he ended up as head of derivatives product engineering at the American Stock Exchange.
Yeah.
And they desperately needed a Hail Mary. They were essentially dying in their battle, getting squeezed by the big board, NYSE on one hand, and the NASDAQ on the other hand as the upstart electronic exchange. So they decided they would create some sort of tradable equity index product. It was kind of commissioned inadvertently by the SEC's report into Black Monday, the 1987 crash, where they said, well, how about we had some sort of cash product that sits somewhere between futures that kind of snowballed, the selling of futures and snowballed and exacerbated the crash, and the cash market. So they thought, well, let's create tradable index funds. He ironically went to Jack Bogle, who absolutely detested the idea of tradable index funds. And although they got on really well personally, I spoke to Jack about it, and he said, look, Nate Most was just a gentleman of integrity of the highest order, but I just hated his idea. So I chucked him out of my office, essentially. But that became the exchange traded fund, which is, now I'd say ascendant over index funds 1.0, and is a far more flexible wrapper that people can put a lot of things into, including a lot of really dumb things that shouldn't be seeing the inside of a financial wrapper in any day, I think.
The Purdy gun.
Yeah.
Tell us about the Purdy gun real quick.
Well, this was Jack Bogle's metaphor for it. So the Purdy gun, it's a shotgun that was one of those popular game hunting shotguns in the UK, around the turn of the century, but also became really popular way of killing yourself because it has such a powerful blast. You weren't going to make a mistake with a Purdy shotgun. Right. So Jack Bogle said, like, ETFs were like that, like a really useful tool for a lot of things, but you can also, blow your head off with it very quickly. And I think with ETFs, look, I try not to get too dogmatic about it. I don't mean my Norwegian social democratic side shining through here. But I think that just because we can put everything into a product, and you shouldn't tell consumers always what they want or shouldn't have, we still allow people to buy booze or cigarettes, even though it's bad for you. Yeah. I do think financial health is almost an order of magnitude more dangerous. That people can do quite a lot of damage to themselves, but also the broader market ecosystem with some of these products that I probably think I'd wish I'd never seen the light of day.
Yep. I think of a lot of these ETFs as wolves in sheep clothing. They're brought in, and these brokers who couldn't really sell index funds before because they weren't getting paid, their firm wasn't getting paid. These are really low fees, no commissions. And now all of a sudden they can look like they're doing the right thing for their clients by giving them index funds, but then they're trading them like wildfire and embedding all these other crazy things into the ETFs. So I'm not a big fan of the ETF wrapper. It does have a little tax advantage, but passive investing is meant to be held passively as well, not just the investment itself.
Well, I think one of the reasons why Bogle softened slightly towards the end on ETFs is that he actually, he was a guy that believed in the data. And as it happens, the broad passive, classic index funds in ETF wrappers are not that actively traded. So SPDR, the biggest equity ETF, is the most heavily traded equity security in the world. And there's an ecosystem of derivatives built on top of it as well. But broadly speaking, money in ETFs is actually way stickier than many of the opponents would admit. And even Bogle said that actually the ETF has helped broaden out the indexing revolution. So for me, it's not even necessary that you trade SPDR day in, day out, though you obviously shouldn't do that. Yeah. It's more that it's a wrapper that you can put, derivatives of derivatives of derivatives into. that, frankly, even specialists struggle with. And my favorite case was Robert Wally, a finance professor that invented the VIX index, once bought a VIX exchange traded product. He invented the index and he didn't understand the product, and it blew up. And he said, yeah, that was, he only lost a few $1,000s.
Right.
But it goes to show that, we allowing ordinary investors to buy things that normally they would not be allowed to buy purely by putting an ETF wrapper. So retail investors would not be allowed to touch VIX futures, or certainly not a complicated bundle of VIX futures any day. But if you put them into an ETF, magically, you somehow cure it of any sort of regulatory ill, and you can sell it to ordinary investors that have no clue. My favorite example is the long VIX ETFs, or exchange traded products, because some of them aren't technically ETFs. You would have made more money by investing in Bernie Madoff than investing in these long volatility products. But they are massive cash incinerators because of all sorts of technical issues. But they are still sold by, frankly, a lot of financial advisors that maybe don't know better, or bought by retail investors who don't realize the massive headwinds that the curve backwardation has for them. So I do worry about that. It's securitization. This is one of my favorite topics, as you can tell, but securitization has been a wonderful invention that's helped lower the cost of borrowing for a lot of people. But you can do dumb things with it. And we as humans do this all the time. So I think the ETF is a wonderful invention, but like securitization, if you do heinously dumb things with it, terrible consequences can arise. And that sometimes I do worry a little bit about.
Wells Fargo Financial Sciences 2.0.
So this is, also one of my favorite story arcs. I love it when you start one place and then almost like sleight of hand, you end up back there.
It's so, like, what?
After Mac left and Bill Faust left and Verton left, and essentially Wells Fargo Investment Advisors, that it was called, never made any money for 20 years almost, because they'd basically hired lots of really smart academics that weren't really commercially minded. But then they eventually, when they were close to collapse, and had a massive falling out with Wells Fargo, the bank, they hired a guy called Fred Grauer, former academic turned Merrill stockbroker, who'd actually been sacked by Faust after a very brief stint at Wells Fargo.
I love that. I love that too.
Incredible, right? And then he comes back as the CEO.
Let me say one thing real quick. I actually knew a guy who was on the board of directors of Wells Fargo. And so I had figured all this indexing out, and I met him and I said, why in the heck did you sell this? What a great thing. He says, Mark, it didn't make any money.
It never made. I mean, it's astonishing in many respects. We can now see that, we know what WFIA became, and we'll get to that. But, it's almost Herculean how long Wells Fargo put up with this massively expensive, indulgent group of very arrogant academics who got paid better than the banker at Wells. They got paid better than the banker at Wells. All the bankers at Wells got paid less for actually generating the profits that subsidized WFIA for almost 2 decades.
It's kind of interesting. Wells Fargo created both of these and really didn't benefit from them.
Well, no, certainly not Wells Fargo. They did benefit. I mean, they did essentially sell. So obviously, then they sold half of it to Nikko in Japan as a part of it's a halfway step to divorce, and then eventually the whole thing to Barclays, the UK bank, and it became Barclays Global Investors. And they could see when Nate Most and the Amex and State Street, who was their asset management partner with ETFs, were selling index funds, essentially as way they saw it, essentially index funds that they were selling to institutional clients for 5 basis points. They were selling for 20 basis points at the time. So they thought, well, let's start some ETFs. Morgan Stanley also wanted to build up this indexing business that they own in a joint venture with Capital Group called MSCI, Morgan Stanley Capital Investment. And, they did that together. So that became WEB's World Equity Benchmark Series. And it was a failure. I mean, and people forget this, that the ETF was not an overnight success, far from it. So it was partially done because they thought it might have some commercial potential, but it's also a favor to Morgan Stanley. But, I wasn't able to stand this up entirely to a journalist's liking, but I heard from one person involved that Morgan Stanley eventually sold their interest in Webs back to BGI for $1. $1 for their, I don't know what the exact ownership equity stake would have been, but presumably 50% or so. And eventually they decided under Patty Dunn, also one of those great underappreciated American CEOs, and a phenomenal personal journey from secretary to CEO, which is pretty phenomenal.
Yes.
She realized the potential. So she financed an overhaul, led a guy, sort of a brilliant guy called Lean Cranefuss, and rebranded it Webs. And that became iShares, which is now the world's biggest ETF brand. And they basically blew State Street out of the water. Vanguard was hamstrung by Jack Bogle's reluctance and hatred of ETFs. State Street didn't quite realize the potential of what they had. And Cranefuss, financed by Dunn's money that she got from Barclays, essentially did what Silicon Valley now calls blitz scaling. They basically just bombarded, they bought up options on almost every major index because they realized this is where you get brand, you build up real estate, you seize the real estate, you control it, first mover advantage. We do this in every asset class. And they went nuts. And it costs a lot of money, but my God, what a success it's been.
And now these indexes have become such a prominent business, really, because of all these index funds. One of the things I like about Dimensional is they create their own indexes. They have all the dimensional indexes. And so they avoid all this costly a part of licensing these indexes. And they also avoid this front running because these indexes announce themselves that we're going to put these stocks in and take these stocks out. And then all the traders come in there. You can probably make a pretty good active trader business out of just doing that. And I think some people do. And so that I like to call dimensional indexes the silent index because nobody really knows what they're doing in there. They really have, I would say, perfected this whole passive investing strategy.